Okay, so good afternoon, and let's explain to you this afternoon the approach that X5 are taking about analyzing information as to be able to not just look at stuff in the past, because whenever we're looking at our Zero, our QuickBooks, our Sage, and looking at what purports to be management figures or what traditionally has been management figures, we can do nothing about it because it's all what happened. What we're trying to do is look at the figures that we are now analyzing and how we can then look into the future. And so we're lucky to have with us today Steve Darnell, who's one of the authors of this software, who has actually been consulting with us as well to help develop the software that we're using as part of the virtual finance director service we're offering. But this is, you don't have to have the full service that we offer. This is just to give you an introduction as part of our internal training, as well as making clients aware. So this would be recorded onto our website, which is where you'll be seeing it now. So over to you, Steve.
Okay, thank you, Mike. So I'm going to pose a question. So, where do you want to be, and how are you going to get there? And the honest reality is unless and when two people get together, it's a pretty important question, because if I don't know where you want to get to, if the team at X5 don't know where you as a client want to be, and they don't know how you're going to get there, then not really in a particularly good place to actually try and help you get there. So just as food for thought, I see we all know Alice in Wonderland. So yeah, Alice bumped into the Cheshire Cat and asked the question, so would you tell me please which way ought I to go from here? Asked Alice. And that depends a good deal on where you want to get to, Cat. I don't much care, said Alice. Then it doesn't really matter which way you go, said the cat. So the metaphor for this conversation is that unless you have a clear idea of where you want to be, and preferably by when, you haven't got a plan. You need a plan. And if you haven't got a plan, team at X5 would love to sit down with you and discuss where you'd like to be and by when, not just in your business, but also your business is fulfilling or helping you fulfill your personal goals and objectives for not just you, but for your wider family. So this is what we're going to go through today. We're going to go through an agenda that starts with, just a consideration of a question. So we'll put a time frame on it. So if we were to meet in 5 years' time, what would we like life to look like in 5 years' time, and how would that differ from today? And the key thing is not just about if my business was turning over more and I had more profit, and it's, how would your life be different? What would you do that would be different to that which you're doing today in an ideal world? Because once we know that, then we can work out whether we're moving towards making that happen. The probability is everyone we speak to has got frustrations, stresses, and barriers that might make it more difficult to achieve our objectives. So unless we actually know what those stresses, those frustrations, those barriers are, we can't start to engage intellect on identifying solutions and options to actually overcome those stresses, frustrations, and barriers. And so if we want to get from X to Y by in 5 years' time, then what's the current reality? So if we use an example, so if we wanted to sell our business in 5 years' time, and we really needed 1.5 million to live the lifestyle that we wanted, it's no good sitting there saying, well, I'm going to sell my business in 5 years' time for 1.5 million, especially if the business is only going to be worth 500,000 in 5 years' time. You've got a gap of 1 million. So how would we bridge that gap? Because if not, what you're going to do in 5 years' time is not what you want to do. You might be working for a lot longer, or you might just have to accept that most of your dreams and aspirations are not going to be realised. So ideally, what we end up with is a plan. We agree a plan. We understand whether the gap can be bridged, and as long as we agree that we can actually achieve the goals realistically, we work up a plan to bridge the gap. And if we're in agreement and we know what we want to do, and if we can be part of the journey, then we'd like to sit down and discuss next actions. So does that sound reasonable as an agenda to have with anybody at X5, or from the X5 point of view with clients?
That's fantastic.
Thank you, Mike. So please do chip in at any time with questions, guys. So here's a question. I think this is a really great question. Just so, imagine if we were just about to have a meeting 5 years from now, what would have to have happened in your personal and professional life for you to conclude that the time had been an outstanding success? And it's quite a profound question. And yeah, we would ideally spend quite a long time really understanding this one. So, this isn't about the, just something expressed in numbers, but this is just, talk about life. What would you like to do differently? Is it getting your kids through college? Is it buying a yacht? Is it buying a house on the Algarve? Is it immigrating to Australia? Is it, helping get your kids set up in houses? It could be anything. Everybody's got a different dream and an aspiration and a different time frame. But if you don't have a clear picture of what you want to achieve, then you have not in a good place to have a plan. And I think for most people, we'll have to accept that there are problems or issues that would need to be addressed and opportunities that would need to be realized along the way. So if you're watching this video and you haven't had this conversation yet, please think about these questions and write down your answers, because only when we have more information can we come up with a robust plan that would actually help you achieve your goals. So we'd probably spend quite a long time in a meeting with a client talking all about them, their aspirations, and it doesn't say their business at any stage in those two questions. The business is just a part of the bigger picture. Does that make sense?
Yeah.
And after that conversation, hopefully what you've got is you can just make sure you've properly understood it. So by just recapping and saying back to you, and I would say to you as a client of X5 or a prospective client of X5, you want to make sure that the person you're speaking to really does understand. So they should be able to tell you what you just said. They should be able to describe what your perfect goals would be, your aspirations, and how your life would be different. Because if they understand that, that they're on your side and they understand your situation. They ought to be able to actually explain to you and probably help you clarify in your own mind exactly what the barriers are along the way. And then the next bit, which might be less palatable, but has to be deal with reality. If not, we're in an imaginary fairyland. Back to Alice in Wonderland. What is your current reality? So, take the example I used earlier. If you want to exit in 5 years' time at a 1.5 million valuation, the actual extrapolation of current performance means you're only going to get to 500,000 valuation. In fact, it could be worse. It could be 500,000, but you can't sell the business because it's too dependent on you. There's not enough transferable value, etc. What is your current reality? So what will almost certainly happen is the team at X5 will have spent some time analysing, investigating and understanding what's going on in your business before they turn around and talk to you in order to have a conversation based on facts. So we use a real business here. These real numbers, it's all just anonymised though. So here is a business.
Steve, can I just interrupt a slide? We also have a template that's just a very small, simple template. It's a 10-year template, which starts with now and then 10 years time, which goes through the business, through personal houses, etc., wealth and health. So so you go through the areas in terms of map out your life. So just trying to give a little formula. Sometimes clients find it easier just to look at it in that sort of framework over a 10-year gap, and then if they want to do it each year, they can do, but they can maybe go to the middle or then go to year 10. But either way, it's just they're writing it down so they can actually identify the gap that they need to help or need to just think about achieving, how they're going to fill in the gap.
Okay, perfect, absolutely perfect. So I'm going to just to touch on a couple of the analysis and reports that X5 would undertake on your behalf, and the information they would give you, which helps you understand better what's actually going on in the business. And this looks at some of the key performance indicators, the lead indicators that you really ought to be tracking in your business to make sure that your outputs, the sales and the profitability, hits your desired targets. So we look at number one is total number of transactions. So if we add up every single transaction and report every month, ideally the total number of transactions, this is every single transaction over the last 12 months, every single month we would expect that number to be increasing. And you can see in this business, good news, they've gone from 4,141 transactions to 4,360. I'll reveal the turnover in a moment. that increase in the number of transactions has or should have delivered a increase in sales to the tune of about 50,000 if those additional transactions were all average transactions. So these are all averages. However, the average value per transaction, and likewise, this is a statistic, it's really, really important, but very, very few businesses actually will track this number. Very, very few accountants will actually help you track and record this number. And yeah, even if the timing's not right for you to work on a properly paid for professional basis with X5, they'll even give you this as part of the sort of standard compliance service. So, what's happening on your average value per transaction? And in this case, this is reduced by a little bit, but that little bit, once you multiply it by a large number of transactions, has had a negative impact on sales. So all the gain, the 50K progress we made, has been written off by the reduction in the average value per transaction, which means that we've actually gone backwards in sales by £2,000 down from 1,000,003 to 1,000,001. And let's dig a little bit deeper. So customer drivers. So the total number of transactions is a function of the number of customers. So what's going to happen to the number of customers in any business? Well, it's going to be driven by three things: the number of customers at the beginning of the period, plus the number of customers acquired in the period, minus the customers lost in the period. And every business has a rate of client attrition. So number of new customers acquired. So this business, last year acquired 79 new customers. Unfortunately, he's got a red cross against it because that's a reduction from the previous year where they acquired 98. So this business has got a problem with new customer acquisition. Order of magnitude, how big is that problem? It's only 19 fewer clients, only 19. Those only 19, all other things being equal, would have been worth about 11% of turnover. So we could have got our turnover up by 10%. We'd also look at retention rate, and again, these are being recorded every single month, so you can see that's how it's moving month by month. It should always be increasing. If it's not, we ought to be investigating why and looking for strategies we could deploy to address it. So we've got a movement in the retention rate, down by 4.2% with some rounding. So that's only 4.2% of clients. However, that 4.2 has cost us 44K in terms of lost sales. So just this one small part of just one small bit of analysis, we've identified potentially £200,000 worth of sales. That would have increased sales from 1 million to 1.2 million. However, revenue is vanity, profit is sanity. You can't see it here, but we would, part of the report would actually tell you that this business is trading at about a 35% gross margin. So a 35% gross margin on 200,000 of sales is £70,000. I think all of us would be quite happy to put £70,000 in the back pocket or into the business's bank account, rather than having it seeping out of the business just because we weren't tracking the right KPIs. Does that make sense?
Yeah.
So let's carry on. So there's this one report. There's also a much more detailed report where the very first thing we look at, almost on page one, is we look at the business and we assess a whole load of different KPIs, universal KPIs that apply to every business. And we either got good news, in which case we just identify the good news. But if you want to make an improvement, we can make the good better, almost certainly. But we really ought to focus on what's going in the wrong direction and work to reverse the decline before we do anything else. So you can see this particular business, revenue's down by a bit. We already know that. The average value per transaction is going down. The rate of customer acquisition is going down. The rate of customer retention is going down. The revenue exposure has increased in the last 12 months. The top 10 clients now account for more turnover than they did before, up by 6.6%. So the risk of this business and its saleability has been adversely affected. They made a profit in 7 of the last 12 months. That's down 2 months on the preceding year. The net worth of the business has decreased. And whilst every single business is different, and your business will not look like this, I've only ever seen one business that's got nothing but things in the tick column. Now, actually, that technically was this morning. It's very, very rare that you find a business that hasn't got significant scope for improvement. And a lot of these scope for improvements, they're going to have a direct impact on not just the long-term profitability, but the short-term bank balance. So another part of this report would dig into and understand in terms of the analysis of looking at the accounts receivable. So you can see here, this particular business, they are not very good at collecting their cash. So they've got £196,000. That's this number here, currently in somebody else's bank account, and there's a risk that they won't get it because it's taken them on average 71.8 days to collect their cash. That represents an increase of 2.9. So, you know, if you've got problems with collecting cash, please do speak to the team at X5 because they can very quickly help you get up and running, surprisingly cost effective. Yeah, I would say for this business, there's a reasonably good chance, we never know for sure, but there's a reasonably good chance that actually those debtor days should be more like 35 days, just over the month. If we can achieve that, then this business would basically put an extra £100,000 in the bank account, cash. So if that was the outcome of having a quick conversation with X5, that would certainly be a worthwhile outcome. But what I want to do is now is just look at the future. What might happen to the business is going to be a function of, you know, extrapolating historic performance, and then going one step further with the historic performance to actually see what we can do to, you know, improve the underlying trend. So if I pull up the model here, it should look very similar. So in this model here, and there's two tabs on the model. I'll just go in here first, and I'll just start by just putting a 0 into all of these cells, and I'll explain what I'm doing in a second. Right. So what we've got is 1, 2, 3, 4, 5, 6 input drivers. So these are key performance indicators that apply to just about any business. First one is the rate of customer acquisition, and that's either going up or going down. And as we already know, in the case of this business, it's going down, or it went down in the last 2 years by 19.4%. The green box is a forecast. It says, well, what's going to happen next year and 2 years out and 3 years out and the next 5 years? And that's what's on the second tab. So for the purpose of this exercise, we'll just assume that, yeah, we can repeat next year what we did last year, not in terms of the trend, but the absolute performance. Do the same with customer retention. We know with customer retention is going backwards. It was 51.1% of clients retained, and that's a deterioration there of 4.2% year on year. So that trend ought to be 4.2% in there probably. Good news is the number of transactions increased, the average transaction value decreased, gross margins improved by 1%, and the overheads were 2.7 down. But I'll leave noughts in all of these. So yeah, what we can then do is we can modify the these underlying assumptions and see what impact that would have on the profitability and the long-term value of the business, or get an indication of that value. So what we've got on this tab here is we're just taking these numbers. So these are the different figures we put in there. So in the last 2 years, new customer growth declined by 19%. And we're just going to assume it's going to stay the level, about 0% right the way through here. Then look at retained customers. There's the 0 that I put in the previous cell, and therefore we're going to retain 51.1% of our customers every year. So we're basically replacing, we've got to replace our entire client base every 2 years just to stand still. Look at the average number of transactions per value. That doesn't change. Neither does the average transaction value. Neither does the gross margin. Neither does the overhead. So you look at what happens here. We obtained 79 new clients last year. We're going to obtain 79 new clients next year and the year after, and right the way through there, which, you know, great. We're going to increase the number of customers, but no, we're not. Because if we look at the number of customers lost, if I lose 51.1% of my customers, I had 175. So unfortunately, 51.1% is 86. 86 is greater than 79. Therefore, I'm going to go backwards. So my number of customers, my net number of customers that I'm transacting with, is projected just by taking last year's performance and repeating it to reduce each year for the next 5 years. So if that happens, bear in mind everything else is held level. That change alone means that the turnover is going to go down from just over 1 million to 926. I've held my gross margin and unrealistically my overheads level. So even if that sort of somewhat, you know, rose-tinted optimistic view of the world, if I am running this business and I'm taking, let's say I'm taking this net profit comes out as a dividend, you know, I'm probably feeling quite comfortable and bullish that I've got £20,000 more in my back pocket as a result of my relatively good year last year to this year, despite these worrying trends. However, if that continues over the course of the next 5 years, my net profit is going to go down by 53. So the £80,000 I've probably paid myself or will pay myself this year, I'm going to have to tighten my belt and live on £26,000 per annum less, which is obviously not a very attractive proposition. If I go one step further and we look at what's the impact of that reduction in the profit on the value of the business, because it will have a direct impact on the profit of the business. We calculate that by looking at the EBITDA, and the EBITDA is the earnings before interest, taxation, depreciation, amortization, and dividends up here. So the movement in the value of the business is going to go backwards to the tune of minus 26k. And the impact of that negative movement in the EBITDA, if we take, say, a 5 times multiple, and obviously it varies from industry to industry, but a 5 times multiple means that the value of this business is potentially going to reduce by 131,000. So if this was your business, unless you were reliant on this business for your food and keep, now would be a good time to sell it. Or better still, if we want to grow the business and actually improve its equity value for a more valuable exit later, or just to hand it on to the next generation, or whatever the plan for the future is, it'd be sensible to start to look at, well, what do we think we could do going forward, and what impact would that have? So we take these numbers here, and let's look at customer acquisition. I've gone down by 20% in the last 2 years. So if I was to put a 5 in here, 5% increase in customer acquisition, I acquired 80 customers, call it. So I acquired 80 customers last year. A 5% improvement would mean I get 5% of 80 additional. So 5% of 80 is 4. I'd get 84 new clients in the 1 year, and then a slight increase each year going forward. So that 5%, I think someone's tapping their keyboard, so you just put yourself on mute just in case. So 5% per annum times 5 years, that means that in effect we're projecting here that we'll improve the rate of customer acquisition by 25%. In other words, it's going to take me nearly 5 years to get back ahead of where I was one year ago. Likewise on customer retention. You may not know this, but the average rate of client attrition or lost clients for UK businesses runs between 15 and 20%. And to be fair, that's the average statistic for accounting practices, which are a bit like banks, where typically clients don't move. But if you're losing clients at the rate of 15 to 20%, that means that every 5 to 7 years you've got to replace your entire client bank. So it really pays dividends to focus on the client retention statistic, because the honest reality is if you sit down and look at this statistic on a regular basis, ideally monthly, that would inevitably start a conversation about, well, what could we do to improve customer retention? And in addition to the whole list of things that the guys at X5 have got as ready-made strategies for improving retention, just the conversation itself and talking to your team, you'll come up with ideas which will improve it. So let's assume that we can improve that by a little bit and get from retaining 51% of our clients, improving by 2% per annum. That means by the end of 5 years, I'm going to retain, or hope to retain, 61% of my clients. I don't want to be overly rose tinted. So, average transactions per customer increased last year by 5.3%. So I'll leave that flat. So let's assume we can keep that the same. And I want to look at this one here. The average transaction value, we know from our previous investigation of the statistics that average transaction value went down. We almost certainly can do things about that. And for most businesses, the easiest, fastest, quickest, most palatable way to increase the average transaction value is to put the price up. And the honest reality is that most buyers, most customers, they expect the price to go up every year. So if you're not putting the price up every year, probably ought to have a word with yourself, because that's not smart. Your suppliers put prices up to you, so you should pass that on. But if you do put your prices up, the beautiful thing about price rises is that goes straight through to the bottom line. So 35% margin business, put 3% on the average transaction value, that will put a little bit more than 1% on the gross margin. But again, just by looking at and tracking and thinking about the gross margin, you will come up with a series of strategies that you can deploy to improve gross margin. And finally, overheads. If we're going to do things, and doing things probably means making some investments and making some prudent investments and making sure they deliver. This is going to cost some money. So let's just do a what if, and we put small numbers everywhere else. Let's put a huge number into the overheads growth. So 10 times 5 years, 50%. I'm going to project that overheads will increase by 50% in the next 5 years, and we'll see what that does to the model. So what you've got now with these slight improvements and slight increases, we're going to take the number of customers acquired from 79 to 83. So that's an increment of 4. That's 1 client a quarter, 4 clients a year. And you can see that's a very small increase each year as we go through the next 5 years. So we ought to be able to blitz that and do a lot better. And it's also positively influenced by, we've got a slight improvement in the number of clients retained each year. So you can see here, I'm going from 92 to 82. I'm actually going backwards in my first year slightly because I'm still, not acquiring enough customers to replace the customers I've lost in year 1. So we've got that slight improvement, slight improvement, slight improvement. So we start to see that the number of customers, is now moving upwards as we go forwards. Sorry, that was rubbish, wasn't it? 83, 82. I've gone up by 1. I've gone up by 1. So I've got a very small improvement in the number of customers through the next 5 years. However, you already have seen that if I look down here at the impact on sales, I've got a slight increase in my very, very small price rises going through each year, which will not phase any customer as long as they value the service you deliver. My sales have now jumped from 1 million to 1.5 million. And even with my huge whacking increase in my overheads, my 50% increase in overheads, the profitability of the business, with a bit of rounding, I've gone up by nearly £100,000. So rather than potentially facing a tightening of the belt and being £26,000 per year worse off, we could be looking forward to being £100,000 per year better. Now, clearly, in our conversation previously about what we like to be in 5 years and what difference would that make to your life, it could be that £100,000 has just knocked it out of the park, has blitzed it. We've done it. Happy days. We probably set a new stretch target at that stage because you can review this every year. And we talk about the valuation of the business, what's happened to the business value. So not only are we able to now to draw down an extra £100,000 per annum as take home potentially, we've also got a positive movement in the EBITDA of the business. It's gone up by 95, and previously, if you recall, that was down at minus 26. So if we take that same 5 times multiplier, the value of this business, rather than going down by 133, which was what it was projected to do previously, just if we repeat last year's performance, the value of the business is going up by 477. So I don't know about you, but my math says that's about 0.6 of a million. So if we could work with you on your business, and this is real figures for somebody, but they're not actually your figures, but your figures, and get you an extra £100,000 per annum and increase the value of your business by 0.6 of a million, $6 million question, what would that be worth to you? I've asked that question of various people in various circumstances, and I think the answer is, most people come up with an answer of it's between 20, 25, 30% is the normal answer. Be nice to think it was the value of the business, but let's just assume it was just £100,000. So on that basis, that this transition, this was worth £20,000 to £30,000 per annum would be a reasonable investment. I would suggest if you're having that conversation with any of the team at X5, they would reassure you, say, well, you can have all of that because actually our increase in fees are in these overheads. So actually all of this gain will cost you nothing. And then the real question is, right, does that sound like that makes sense as a reasonable, equitable deal? Because if anything, this should be a really, really pessimistic goal. I just have to do one more thing at the end of this, say, look, don't forget that's a view of what the future could look like, and that's what we'd like to make the future look like, but the cost of doing nothing is a different number. So let's assume that we can improve that, so just not as bad, but we still got a negative trend. I've got a negative 4% per annum going on at the moment on customer retention, and if I level out everything else, and we just look at the impact of these 2 drivers and not being able to get them back to 0, but just have a little bit of a trend still in the same sort of directions we currently got for this particular business, Unfortunately for this particular business owner, in 2 to 3 years' time, he hasn't got a business. This is bankrupt. It's run out of cash. And it's run out of cash because it's not acquiring enough customers and it's not holding on to customers long enough. Now, clearly, that's not what we want to happen. So, stick with the idea we're going to increase the value of the business by 0.6 of a million, and we're going to potentially increase the drawings of the shareholders by £100,000 per annum. Does that make sense? So I did that quite slowly, but we've covered quite a lot of ground. So any questions on that?
Can you just revisit the customer retention bit, where we originally did the 2%, just to work those figures through, because that was quite there was only a small change, but where we had 0 and then we put put a 2% customer retention.
Okay, so if I put let's go back to naught in there. Sorry,
that's it.
I put a naught in there.
Yeah.
No, try and get that in there.
Naught
in there. So we're only looking at one variable at the moment. So I've put a naught in there. If I put a -1 into customer retention, that would see the number of customers reducing, and therefore the sales reducing down to 850,000.
Yeah.
If I can improve customer retention by 1%, so I'll go to the other end of that, and I come back to this model here, I've now gone up from 860 to 1 million.
Yeah.
So the sensitivity of some of these variables, and it's different for every single business. Some of these variables have much more impact on turnover and profit than others.
So what we're saying, by adding 1%, it's 5% in 5 years. So we have a 5% improvement in 5 years, and the compound effect can be quite remarkable.
It can be phenomenal.
Yeah.
Yeah. Any other questions? Okay. So if I come back to where we were before, then back to this one here. So we know what can be achieved. We believe we know what is realistic and what we could achieve, but we need a plan, because just having an aspiration isn't a plan. So we have to have a plan to bridge the gap and to make it happen. So if I go through, just think about what happens in most cases. In most cases, most accountants don't even do this, and depending on what services you're taking from X5, ideally you've got cloud accounting. Ideally, you've got regular reporting, so you should get monthly management reporting. And X5 are going to start delivering monthly management reporting for all clients as part of the standard engagement with clients. Most accountants, you won't see your accountant from 1 year to the next, and when you do, you'll be talking about stuff that I would call ancient history. In other words, the management accounts, the stuff you have to submit to Companies House and HMRC, which is typically 6 months out of date by the time you see it. Move up from that. Ideally, we move not just reporting, but a proper robust set of management accounts. And management accounts really is the dashboard. It's like the instrument panel on your car that tells you how fast you're going, whether you're running out of petrol, and all the key stuff you really need to know about your business. Ideally, financial and non-financial indicators, lead indicators. These are the things that move first before the lag indicators, the sales, the profit have actually taken place. Ideally, you'd also have the opportunity to ask questions, to get a sounding board, just run ideas past someone who has your best interest at heart. So that can be ad hoc, or ideally we'd be participating in regular management decision making if that is appropriate, if it helps your business. Helping to actually facilitate making better decisions, and as accountants, we ought to be looking at the ROI. We ought to be looking at what's the desired outcome. You're going to do spend some money doing X. Marketing is the biggest culprit here. So we're going to spend lots of money on marketing. Exactly what do we want to happen as a result, and how can we measure it? Because only if we have that answered can we actually measure it and report it, to report the outcomes. And if we're measuring the ROI, if we're spending money on marketing, which is just subsidizing Google, which is probably where most Google's money comes from, it's not generating an ROI for the business. We're making a real difference. And what you've actually got here is this is if you like, this is the management reporting pack. So we're providing management reporting. clearly we're not just going to provide the reports and never take any calls. So if you've got any questions, pick up the phone, speak to us, and we'll help you through it. But if you want a much more robust, hands-on level of support, this is our part-time FD service, where effectively, we can be your entire financial team, so you can focus on running your business and making the money, and we just help you make sure you keep hold of more of it, and keep track of where it's all going on a day-by-day basis. Any questions on that? Does that make sense?
Yeah, I think that's very clear.
Okay. I work with a lot of different practices, and I'll tell you what, the number of accountants who deliver part-time FD services, let alone management reporting, is very, very, very few and far between in reality. You're in good hands with X5. You're almost certainly thinking, okay, how much is all this going to cost? So let's just give an order of magnitude, and it will vary depending on exactly what you need, and it will vary slightly from business to business. But as a guide, there's a process we go through. You could either just have, sorry, go back up, occasional discussions, run reports, and we'll sit down and explain what the different reports need. And obviously we'll have to charge you something for that, because that's going to take some time. What we'd much rather do is, rather than charge you ad hoc, is just charge you slightly more on your monthly retainer. And we'd like to deliver a monthly management report, including all the analysis, so you've got a track of all your key performance indicators. Ideally, we would give you a report, measuring and reporting on performance versus plan. But in the absence of a plan, the best we can do is give you a report of this year versus last year. And this would include, looking for lots of opportunities to, reduce costs or to increase profitability. Ideally, we'd have a plan. So to get a plan, there's really two ways to get the plan. We could either do if I can use this term, a quick and dirty. We'll ask you some questions. We won't really work with you. I haven't got time to really, test and critically evaluate all your answers and all your assumptions and what we think we can achieve, what you think we can achieve. But we can build you out a robust 5-year, 3-way forecast. And if you wish, we can use that and extrapolate it to actually help you appeal for funding and get funding from various lenders, or to help you raise equity if required, or if you're looking to sell the business, to get a valuation on the business and potentially facilitate the sale of the business at the appropriate time. Better than that, we would rather sit down. I'll show you what we would go through on this in just a moment. Rather sit down with you and do it properly. And do it properly means us asking lots of questions and really working out what is a realistic plan and what are realistic metrics for how we're going to improve the KPIs we looked at on that very quick superficial model we just looked at. So this might take 3 months, and we might be spending 2 or 3 days a month working with you in terms of the time we spend with you and the time we spend analysing and putting the work plan together. And because you don't know what the value of that might be, what we're prepared to do is say, look, we'll give you 100% satisfaction or your money back guarantee. So over the end of 3 months, if we work through this process together diligently, if at the end of 3 months you feel you haven't got value for money, it hasn't been absolutely outstanding, just say so. We'll give you all your money back. We'll ask you what you think our time together has been worth, and that's all you pay. Ideally, what will happen is that will be such a positive experience that you will conclude that you like our participation on your regular management meetings. And if that's the case, then indicative numbers, depending on how much time you need, we might be charging you £1,600 per month for that. And in that number, we'd encompass all of your financial management and reporting. If you don't need us participating at your meeting and you've got the rest of everything happening in-house and you're happy to fly solo, at that stage we can start to deliver you with reporting management versus plan. So whatever your need, whatever your circumstances, there is a package that would work for you. Any questions on that element of it? Because obviously it's not sales pitch as such. It's if we're going to do this, it's a partnership, and £1,600 per month, not much more than minimum cost member of staff, so minimum wage member of staff. But any questions?
I think it's a bargain for what's being offered.
I would agree. Well, if you can get an extra £100,000 a year, and 0.6 of a million on the value of the business, or whatever is appropriate to the business in question, yeah, and all this is going through the overheads, as well as that, then you're absolutely right. So why does it cost so much? What are we going to do in those 3 months? So here are the 3 months. So spread over 12 weeks. Sometimes we can go faster, sometimes we go slower. And I won't bore you with the minutiae of everything in here, but we're going to go through a lot of analysis, some detailed understanding, some detailed questionings, and we're going to look for and try and quantify and understand exactly what we're going to do. And we come up with some priority projects, and we won't complete all of these in 3 months, but we'll know what the plans are. And we'll have these worked into the plan for over the next 5 years for how and when we're going to work on these and the impact they're going to have on the profitability and the cash flow in the business. And I want to look at these three in particular. So we're going to improve collections wherever possible. Normally we can get some quick cash in just by improving the cash flow. The probability therefore in this is a cash neutral or cash positive transaction. We're also going to drill down, and we can't make any guarantees. Every business is different. We look for fixed cost reductions, and we look for opportunities to improve margins. Now, clearly, we get some fixed cost reduction and we get some margin enhancement, even more so. High probability that within the 90 days, you might find actually you're better off, not worse off. So, it really is an absolute bargain. And with a guarantee, well, why wouldn't you? Just to remind ourselves, there are two things here. We went through just the one in particular. Remember those debtor days? We spoke about, there's £196,000 for this particular business sitting in somebody else's bank account just because they're not very good on chasing their clients. And sometimes it's a bit embarrassing chasing customers and asking customers, trying to sell them and be their best friend one day and then harassing them for cash the next. So, it's not surprising maybe we're not so good at it. But you can do this in a very, very positive, friendly, client-friendly way, and you get a significant reduction. So easily get £100,000 of that back into your bank account without any ruptions to client relationships. So really cash positive potentially, and could be massively cash positive for the business. Just to reiterate the guarantee, you want to say it again, Mike?
Yeah, if you don't like what you're getting, we'll give you all your money back, and you just pay us what you think the service we've given you is worth. Take the risk totally away from you.
So I was going to say, so actually, effectively there, so you can't lose. So you're going to get the value of the service, and if it doesn't deliver, then it doesn't cost you a penny. So
you can turn off the tap whenever you want, but each month we'll ask you, and we'll say, so we'll do an exercise for the first 3 months and say, like, let's demonstrate it. And if you don't you don't think it's worth the money that we've quoted, then we'll give you that money back. You just pay us what you think that service is worth, and we don't have to do any more. So it really is win-win.
Can't say fairer than that. So as I see it, you've got three options, or this just applies to any business. You could do nothing. And if you keep doing nothing, well, we've just seen for this business here, the future for doing nothing will be quite spectacularly painful by the look of it. And that's for a business that on the face of it is doing quite well. Their sales didn't go up, but their profitability went up by 20k. So do nothing is an option. You could try and do it yourself, and we're more than happy to give you the reporting and support, and we're going to run this series of workshops. So if you want to come and pick up more knowledge around finance, we're going to do everything we can to give you all the skills and knowledge you need, and even a lot of the management information you need to do this yourself. Or we could do it together, and as you know, the guarantee is in place, so you take no risk. So the DIY option, very, very rarely does it work. And if we do it together, it's almost certainly an investment, not a cost. So I think at that stage, if you want to take action, please, contact one of the guys at X5. Ask for them to analyze your financial detail and book a meeting to talk about how we could potentially help you achieve your goals.